All right. Welcome to today's tax and market update. We are so excited to have you here with us with Financial Solution Advisors. Wow, what a tax season. If you can look in the at the picture on your on this webinar, you can see that was our after tax party, which was amazing. We all had a really good time. So, back to business. So, my name is Shelly Lingor, and I am the CEO and partner here at Financial Solution Advisors. And I also have with me Isaac Brohinsky, who is also a partner and is an amazing uh, person to work with, work for. Good morning or good afternoon, Isaac.
How are you doing, Shelly?
Oh, it's morning, it's afternoon, someplace. I'm doing really good. I'm doing really good. I see you survived tax season.
Yeah, I think so.
Yeah, and a little birdie told me your team won the competition at the after tax season party.
That's
Congrats.
right. That's right. We did. Yeah, thank you.
Yeah, we had super fun. Well, let's get started. Isaac, if you want to take it away.
Yeah, thanks, Shelly. If you remember when we were looking at our webinar at last quarter, one of the big questions that we had was, will the Fed be cutting interest rates in the spring or the summer? And how much would those Fed interest rate cuts be? And at the time, we were looking at it and we thought, looking at economic conditions, they may not cut interest rates. They may wait and they may do just a small adjustment during the summer months. And it turns out that seems to be the case. So we're seeing that now, and it's causing a lot of short-term volatility. Markets are kind of readjusting to this new idea that maybe they're not going to get those interest rate cuts that they anticipated. So that gives us a lot to talk about as we go into the second quarter. We want to look at a few different things. We mentioned inflation, interest rates. We also want to look at unemployment, housing costs, gas prices, and how these things are affecting what we're seeing right now in the economy. And as we do this, the other thing we want to do is take a look at a historical view and what these kind of indications have meant for us in the past, and then also how we should view this with a long-term view and how we should see this as investors who are looking to fund a retirement, looking for financial independence, basically looking to be in this for the long haul, not simply to be day traders or to be tossed about by that short-term volatility. So when we look at inflation, we saw the inflation at a peak in 2022 of about 9%, which was very high, much higher certainly than we're used to. And so the Fed began raising interest rates. And the reason the Fed does that is basically to beat up on the economy and to make consumers go ahead and seek alternatives, delay buying decisions, and do those things that are going to cause prices to have to drop and cause companies to have to put things on sale and bring prices back into sort of that range that the Fed is looking for, which is that 2 to 3% inflation range. So we saw inflation come down pretty rapidly with the Fed interest rate hikes. But then what we've seen over the last quarter is that inflation rate has leveled off. And so the big question is, are we seeing an end to the trending down with inflation, or is this just a pause in the drop and then inflation will continue to drop again? Of course, that affects Fed policy and what they're going to do with interest rates. So if we move on here, what we've seen now is really the longest period of time that we've had an inverted yield curve with the treasury yield. So what this means is that if you're buying treasuries and they're short term, 6 months to 1 year, you're receiving a higher interest rate than you would if you were buying long-term treasuries that are 10 or 30 years. And this is not normal, because normally if you're going to lock up your money for 10 to 30 years, then you're going to require a higher reward for that in the form of the interest rate that's paid. But what happens is when interest rates increase rapidly, when interest rates are high and we expect that they're going to drop in the future, then that short-term yield is going to end up higher than the long-term yield because those short-term interest rates are being driven up and we don't expect them to last. This has commonly been seen as a red flag for the economy, as an indicator of a potential recession, this inverted yield curve, because it's showing that the economy is expecting that the interest rates are going to be cut in the future. And so this is something that, of course, makes the markets nervous when you have this inverted yield curve. But we've had it again for the really the longest period of time that we've seen, and the reason for that is because there's been enough going on in the economy to keep those prices high and to keep the economy rolling along. A large part of that comes from the labor situation. So the first thing we want to look at is wage growth. And we showed this to you last quarter, but wage growth for a short period of time was ended up being below inflation. But then as inflation dropped, wage growth has remained elevated, which means that employees are able to afford more because their wages are going up, even relative to inflation. And so while that may be uncomfortable for them to pay the higher prices, they have the funds and are receiving the raises to where they can pay those higher prices, which slows down that drop in inflation. The other thing that would contribute to that would be unemployment. So it doesn't matter how much of a raise you get. If you lose your job, then you can't pay for anything, right? But what's happened is we still have a significant labor shortage. So our labor shortage right now, we're looking at about 8 million, close to 9 million openings where there are jobs available and people are not filling them. As a result, our unemployment rate has remained very low at about 3.8%, which generally would indicate full employment, where if you are without a job, it's basically because you're in between jobs. It's not a long-term sustained unemployment. And so you may hear about things like the Tesla layoffs and, other companies cutting back on their staff, and they're doing these, 6,000 person layoffs, 10,000 person layoffs. Those are small dents in this 8 million job opening gap that we see. So when you're able to leave a job and pick up a new job quickly, when your wages are on the rise, when you don't have that insecurity, then that gives you the opportunity to pay higher prices. And those higher prices may be uncomfortable, but because you can pay them, you're not going to seek alternatives. You're not going to put off those buying decisions. You're not going to cause companies to have to discount in order to get your business. And that's what keeps inflation elevated. Another thing that, of course, will drive up inflation is housing prices. Now, with the interest rates higher, we've seen housing hurt in several states, but we're not seeing that in Florida. And one of the reasons we're not seeing that in Florida is that more people are moving to Florida than any other state. And so as a result, we're seeing median prices up. We're seeing closings up here in Florida. We're seeing closings over list price are up 31% month over month in March. And so all of that's driving those housing prices up, and it's driving home affordability down. And that's been nationwide. Now in Florida, it's very pronounced, that home affordability index, but even nationwide, we're seeing that home affordability drop. On top of that, you have the higher interest rates, and so that just makes it very difficult for consumers to get into a home. The other thing that we see that drives inflation is gas prices. And you can almost see a correlation from where inflation had been dropping pretty significantly and then where it leveled off. And you can almost see that correlation between that and where gas prices have started to increase again. And there are a few different things that are driving that increase: the unrest in the Middle East, switching over to summer blends, and just lack of surplus here. We had a strong first quarter in the economy, and so we see that people are willing and able to pay those higher gas prices, and because of that, it continues to drive the price up. So what that does is that affects overall inflation, especially if you think of any consumer good that has to be transported from one place to another. So if you have something that has to go from the warehouse to the store and you're paying higher gas prices, that those costs are going to trickle through and flow through, and you're going to see those higher prices not just at the pump but also at the cash register when you're buying something at your store. So higher gas prices will continue to drive that inflation up. So what's the market looking for? We talked about expectations of an interest rate drop, and those expectations, now the market is kind of readjusting to the idea that maybe we're not going to get that interest rate drop, or if we do, it's not going to be something significant and it's not going to be something right away. Does that mean that the economy can't continue to grow and that the economy can't be strong? Actually, that's not true at all. So what we've seen is we've gotten used to, sort of over the last 15 years, this idea of the economy growing best when the interest rates are at zero. But that hasn't been how it's been historically with the economy. We're actually just slightly above the average interest rate that we've had over the last 70 years. And if you look back, you can see that there have been periods of time with higher interest rates, especially if you look at the second half of the 1990s, where you had higher interest rates and you still had economic growth. So I think people are going to become used to having an interest rate, having it be a little bit higher, definitely having it being higher than zero, and understanding that the economy can continue to grow and that companies can continue to produce goods and services that people want and need and convert that into sales and into revenue, which they can turn around and then reward for their investors with. So we want to look back in periods of volatility, and we want to see how the market has handled that over a long period of time, because we don't want to make our long-term decisions based on short-term volatility. So one of the things that you'll see if we look back into prior years is you'll see that the market has ups and downs every year, and that sometimes those drops in the market are very significant and very pronounced, and they can make us very uncomfortable. If you look at this chart, you'll see a couple places where those drops were very significant. In fact, there are a couple different years here where we had drops of 34% in the middle of the year, and two of those years we ended up seeing the market up at the end of the year. So we want to make sure that we're not basing those long-term decisions on short-term volatility, and we want to understand that the market is not something that's just steadily, continuously growing, but that it's an average growth over time, even with these ups and downs. In fact, we see that there's been an average drop of 14% every year when you're looking at averages, but that the annual returns were positive for 33 out of 44 years. And that's just things to know about the market, that it's going to be volatile. You're going to have these short-term drops. On average, we have about 5 daily dips of 2% or more per year. On average, we have a drop of 14% or more every year. And then on average, what we see is that the market drops about 30% from a high about once every 5 years. But at the same time, the market rises about 3 out of every 4 years. And so we want to have that long-term view, and that's how you're going to meet your long-term financial goals and achieve financial independence. So you never want to make those important decisions based on emotion, and you don't want to let short-term volatility derail your long-term plans. When we look at the market, if you look back at 2022, it felt pretty terrible. 2020, especially the middle of the year, that felt really terrible. But when you take that, the ups and downs of the market, and you stretch it out over time, this chart here looks at the last 10 years, then you can see what that looks like over a longer period of time. And so, yes, there are a lot of ups and downs, but we can see the general trends when we look at that long period. Part of the reason for that is because when you're investing in companies, you're not playing the slots or gambling or something, but you're actually investing in a company that is designed, and it's there to provide goods and services that people want and need. And that if something happens with the economy, those companies are going to try to pivot, and they're going to try to find other ways to continue to provide goods and services and things that consumers are going to continue to buy. They may buy less of them during a recession, depending on what it is, but that's what those companies are there for. So you may be looking at now with the higher interest rates, and if you go to your bank and you look at CD rates, those are some pretty appealing rates and some pretty appealing long-term reward for investing into those CDs or into some other fixed income, interest-bearing uh, vehicle. So what we wanted to look at was, well, when CD rates hit their peak, does that mean that they generally at that point are going to give you the best returns over a long period of time? And so what we did was looked back at periods of time where those CD rates hit those high peaks, and then looked at other asset classes and how they performed in the 12 months after the CDs hit that rate. And what we saw is that more often or not, other investment classes such as bonds, the S&P 500, or a mixed 60-40 portfolio, on average, are going to do better in that 12-month period after those CDs hit that highest interest rate percentage. And so because of that, derailing your long-term plan to seek that short-term safety may not be the best option for you. The other question that we get is, well, we see the market, we see that it's kind of hitting new highs all the time. We're seeing, um, we had that dip in 2022, but since then, especially last quarter, we were again hitting new highs in the market. And so people ask, well, should I wait? If the market is reaching new highs, should I wait? Should I wait until the next dip, wait until it comes down the next time, and then go ahead and invest at that point? And so what we're looking at here is investing when the market hits a new high versus investing on just any average day. And remember, when the market hits a new high, it may hit a new high again the next day. And so that's something to keep in mind. And so what we wanted to look at was, is it better to wait until the market drops, or is it okay to go ahead and get in and put more money in, even if the market's at a new high? And what we discovered through this is that it's actually over a longer period of time better even if you're investing at a new high versus any other average day in the market. And so that kind of runs counter to what you would think, as far as, well, maybe I need to try to time the market and wait till it dips and then buy. So when you think about it that way, then it should give you a little bit more confidence, even if we're hitting new highs in the market, of staying with your long-term goal and making sure that you're saving at the rate that's required for you to hit that financial goal of financial independence. So there are a few different things that drive the market. Right now we've seen a lot of the Fed interest rate, the unemployment and labor numbers, which continue to be strong. So people are still working, they're still getting raises and everything. And so it's driving inflation. And so we look at those things as market driving factors. We also look at the national debt. And so the national debt continues to increase. We're still borrowing over $1 trillion a year. And that's really, in the long term, it's really unsustainable. We're getting to the point where our debt service is beginning to cost us more than other government programs, which really cuts into what we're able to do through the government for what it's able to do for the country. Short term, we also had the presidential election this year. That's always a good driver of short-term volatility. But again, we don't want to make our long-term decisions based on that short-term volatility. But then something that's often overlooked in talks about where the market's going to do and what it's going to do is corporate earnings. But that's really what it's all about, because these companies are, again, providing goods and services that people want and need, and that translates to earnings. And many companies use those earnings to then turn around and reward their investors. So we saw strong corporate earnings in the first quarter. We're starting to see earnings come in the second quarter, and again, they appear to be strong. A lot of that is consumers are continuing to spend, people are continuing to spend more, and so that's driving economic growth. And so that becomes a driver of our long-term decisions, because then we can look at these companies and look past the short-term volatility and say, are they going to be able to continue to earn over a long period of time? So what do you want to do in the second quarter? How do you want to stay on track with your plans and with your goals? One thing you want to do is make sure you update your will and estate documents. Now's a good time to do it, especially if you've had any sort of change in your net assets, if you've had a change in beneficiaries, things like that. You want to make sure that your will is up to date, that the things that you have are going to the people that they should go to, that it's clearly stated, so that you don't have your assets don't have to go through a long probate process, or have questions about what your actual intentions were. The other thing you want to look at that is the change in the estate tax that could be coming up. And so we're looking at year-end a change in the tax law, which would basically cut that estate tax exemption in half. So you want to be prepared for that, especially if you're a high net worth individual. Along with those will and estate documents, you want to make sure that your medical power of attorney is updated, that if something happens to you and you're in the hospital and incapacitated, that you have the right person who's making decisions for you. You want to review your financial goals and retirement goals. You want to make sure that you're staying on track with achieving financial independence and being able to afford that type of lifestyle where you're working because you want to, or you're not working at all. That takes time, it takes planning, and it takes making sure that you don't derail those goals partway through and give up on your patience and on the plans that you've put in place. So you want to review those and make sure that you're on track. You want to understand what you own and why you own it, especially with investments. You want to make sure that the investments that you have are helping you to meet your long-term goals. You want to make sure that those investments are something that you're not just getting something so you can ride waves of short-term volatility, but you're looking at things that are helping you to reach your long-term goals. Review your emergency fund and your education funding. So for your emergency fund, you want to make sure that you have funds set aside that are going to help cover it if something were to happen to your job or your ability to earn, or if something were to happen to your house or your vehicle or something like that. You want to make sure that you have enough cash set aside so that you can handle those emergencies as they come up. That's something typically Americans have been very bad at, but something that you want to make sure is part of your financial plan, having that emergency fund. And then you want to look at education funding. There are opportunities for tax advantage education funding, and not just for your kids, but also for your grandkids as well. That may be something that you want to do. Look at tax advantage options for charitable giving. Um, for example, let's say you have to do required minimum distributions. You can do those in a tax advantage way as qualified charitable distributions, and that may be something as simple as having your check that normally goes to your church come directly from your IRA to the church or to another nonprofit. So that's an easy way to take advantage of that qualified charitable distribution and save taxes, even if you're not itemizing your charitable deductions. On that note, with the required minimum distributions, the IRS is giving us a little bit of leeway when it comes to individuals who may have missed that RMD. Typically, there's a pretty hefty penalty if you miss that RMD, but the IRS right now is giving us some options to go back and fix that and get that right without paying those hefty tax penalties. So if you're in that kind of situation, get with your tax advisor and make sure that that you take advantage of those programs. And then lastly, consider tax advantage options for your business and to enhance your retirement savings. So with the Secure Act 2.0, it makes it easier to set up a 401k. There are tax credits that will help you cover the cost of setting up that 401k. And 401ks with profit sharing or cash balance plans really give you a great opportunity as a business owner to save a lot of money that you're paying into your own retirement account. So you're paying yourself and then taking a large tax deduction for that. So if you're not doing that already, this is a great year to go ahead and look at doing that. It also helps as far as keeping your employees in place and offering them a benefit and helping them to start saving as well. So that covers our second quarter market update. And Shelly, I know you have some stuff you want to tell us about our client advisory services and about the world of accounting information systems.
All right. Thanks, Isaac. Wow, what great information. We've got some questions that we'll do a little Q&A at the end of this, but to kick off, big news out there, Intuit QuickBooks and what it's doing. So Intuit announced that they will not be selling any new subscriptions after May 31st, 2024 for the desktop version. It's Pro Plus, Premier Plus, and Mac Plus. The emphasis here is on new. If you are not already on QuickBooks and you want to get in on QuickBooks, get in before the July 31st, because after that, they will not be selling that version. They will continue to update the 2024 QuickBooks Desktop version, but just like the yearly discontinued support on older versions on the QuickBooks Desktop product, this year you will they will suspend support for the QuickBooks 2021 desktop version. So if you have one of those old files, it is being discontinued, which means Intuit will no longer support that version. If something goes wrong, if your file gets corrupted, you pretty much will lose all your data. So, we're encouraging people to go to cloud-based. That's where everybody is going. And so some of the feedback that we get from that is that the QuickBooks Online is so expensive. And there is quite a difference in the pricing, and there is an alternative. So the pricing war continues with online accounting software. We hear a lot of clients, of course, with the QBO, it's just too much money based on what they're used to paying for the desktop version. Desktop versions, writing's on the wall, it's going away. First, Intuit took away the desktop, which they're in process of doing. Desktop back in the day, you'd pay $299, $300 for the software, then you could use it for 2 or 3 years. Then they switched to the desktop product that had to have an internet connection and that you had to renew every year, which is about $540 a year. Now they want everyone to move to online as they get monthly recurring revenue. And let's just compare some of those pricings compared to the desktop. On QuickBooks Online, prices are much higher, but you are getting the latest and greatest technology. QuickBook file with one user, it's called a simple start plan, is about $30 a month or $360 a year. If you need more users, which most people do, you will need to move to the QuickBooks Plus. That allows up to 5 users, and it's about $90 a month or $1,080 a year. Then you have the top of the line of the QuickBooks Online products, which allows you to have up to 25 users and has many more features, but would cost $200 a month or $2,400 a year. As you can see, they are getting way higher margins with the online platform. The standard QuickBooks Pro Online, that would be the $90 a month, the $1,080 a year, which on the desktop, they only get $549. A great alternative that we love here at FSA is Xero. It is QuickBooks Online competitor and is much lower priced and it's affordable for our clients. And it is a valid solution. I mean, the programs do a lot of the same things, just in different ways. Xero has 3 pricing tiers, just like QuickBooks Online. They have the early for startups, which is about $15 a month or $180 a year. They had the growing, which is $42 a month or $504 a year. Then they have the established, that is $78 a month or $336 a year. What's great about it is every one of these zero platforms has unlimited users. You can invite as many people as you want, and you're not going to get dinged to have more users in your software. The established plan also supports multi-currency, which I know with a lot of things going on in trade, that is really important to some clients. So just keep that in mind. If you're interested, drop us a line. Be more than happy to go over the different pros and cons of both software, because each company has a different need. And so what we do here at FSA is we try to, go over your needs, look long term, not just what you're doing now, and give you the tools that you need to move forward. Now, client advisory services. Last update, we told you about a new advanced offering in our client advisory services, and it has taken off, and we are helping our clients leverage AI and data analytics and are building customized advice and predictions tailored to the specific needs of each of our clients. This offering builds dynamic budgets, forecasts, and multi scenario plans, analyzing changes in your business so that you can stay on track and make faster business decisions. We can deliver hindsight, insight, and foresight all in one. So that wraps it up for our client advisory services. So let's move to our Q&A part of the session. Okay, Isaac, I've got some questions for you. What would you say about the minimum wage? I'm hearing a lot about California minimum wage gone up, companies shutting down or going out. Are we seeing that a trend to go across the United States, or what's your feedback on that?
Yeah, sure. California is a little bit of an outlier right now with their $20 minimum wage. And you're right. We've seen it's been highly publicized in the news, some of the price increases, some of the, restaurants that have closed down, things like that. When you raise minimum wages, you're raising costs for a business. And so you really have only a couple of options of where those costs can go. One of those is directly to the consumer. That's probably what happens most frequently. Your costs are raised and you just end up raising that cost to the consumer and passing that on. Another would be through layoffs or through closings and basically cutting costs that way in order to compensate for the higher costs that you now have. The other option is basically a reduction in profits. And so you have some businesses who are large enough that they can absorb some of that drop in profit and combine that with other options such as price increases or reductions in labor force. So that increase in minimum wage, right now we don't see that spreading across the country. We see that more of an outlier with California, although the rest of the country, we have seen a lot of increases to that $15 minimum wage, and that's been a big contributor to inflation as well.
Absolutely. And that's another question here is about our national debt. How
Yeah.
do we stop growing this just obscene number when you look
Right.
at it? It's like, I can't even, yeah. So how do we stop growing that?
Yeah, so as I mentioned earlier, the national deficit has been over $1 trillion for a few years now, really going back
Mhm.
to COVID. We really spiked spending during COVID and we've reduced it a little bit, but we haven't really reduced it a whole lot in the following years. So what happens is with that deficit spending, we get to a point where the service on our debt, the expense that the government has to pay the interest and to pay for our debt becomes the largest budget item that we have. And so that cuts into what we can do as far as, social services, military, other things that the government typically funds. Um, Generally, what you would do to reduce a deficit would be to reduce government spending or to increase taxes. Either one of those is going to provide more difficulty for the consumer, because if you cut
Yeah.
government spending, then you're cutting services that are um, a lot of times paid to private companies, and so that can affect the economy. It can affect the employment of government workers. So that can reduce GDP overall. It can reduce economic growth. If you raise taxes, then all you're doing is you're taking that money from the consumer and you're hitting them from the other side. And so, when you take less money or when you take more money from the consumer, they have less money to spend. They have to look for alternatives, discounts, things like that. Yeah, a lot of times when you're in a period of high inflation, increasing taxes or cutting government spending is a great option to help reduce that inflation, because it takes more money out of the economy and out of the market. We haven't done that. We've increased that deficit spending, and as a result, you've got the deficit spending on one side and the Fed raising interest rates on the other side, and they're in a way kind of working against each other.
Mm, wow. Yeah. It's scary, but yeah, I wish there was a magic solution for that, right? What about consumer debt? Are we seeing, I hear some buzz about that being a little higher or going
Yeah.
up. What's your feedback on that?
Yeah, one of the things that we saw during COVID, we saw, a lot of fear, a lot of, big drop in consumer sentiment, which was, of course, understandable. And as a result of that, people started saving at much higher rates. And so they were putting less on the credit cards. They were actually paying off credit cards, putting money into their savings accounts. And what really kept us from, diving into a deeper recession or even depression with that was, again, the government surplus, or I'm sorry, the government spending and government stimulus that basically pumped money into the economy, kept people employed even if they weren't working, and really, created spending where consumers had pulled back.
Mm,
And so for a while, that kind of created a situation where savings rates were getting pretty good. And we were seeing people pay off debts and things like that. Now that we've gotten past that, things have stabilized. People, like we mentioned before, people have stable jobs, or they can find another job easily, and their wages are going up. And so people are spending, but they're also doing what American consumers do, which is spending more than they make, putting more money on the credit card. And so we're starting to see that consumer debt go back up.
yeah. And then on one of your last slides, you mentioned the emergency fund. How much should a consumer have in an emergency fund?
Yeah, Shelly, let me give you a good standard CPA answer. It depends. Generally, when I'm working with a client, I'm going to recommend somewhere between 3 to 6 months of their earnings, setting that
Mm-hmm.
aside as an emergency fund. But it's really going to depend on their situation. If you have someone who has achieved financial independence, then what they're doing as far as an emergency fund is really what they're setting aside as their cash reserves. They're not going to have as much of a need to build a much bigger emergency fund, because they've got a steady source of that retirement income. Maybe it's a pension or something like that, and
Mm-hmm.
so they don't have a whole lot of risk there. Another situation might be something where you have two incomes in the family, and one of those incomes could support the entire family. When you have a situation like that, you may not need as much of an emergency fund, because if
Mm-hmm.
something were to happen to one member's job, then the other one is still able to cover the expenses. It'll get more uncomfortable, but they're not going to be in dire straits. If you have a situation, especially if you have one primary breadwinner, if you have if you especially if you have an older home or something like that, you definitely want to have those funds available and set aside, so that if you need to replace your car, or you need to replace an AC, especially here in Florida as it starts to heat up for the summer, you have to do those big repairs and replace an AC, then you've got that cash available, and
Mm-hmm.
you can do that, especially without creating long-term high interest credit card debt or something like that.
Very good. Very good. Wow, this has been very amazing. I want to thank Isaac, my co-host here, and we just want to thank you for joining us today and spending your time. If you have any questions or comments, please just put them in the comment box, and we'll be sure to get back to you. And again, thanks for joining. Bye now.